MCX, silver down 6.4% this week. The number everyone is talking about, but not the number that matters. Because while retail traders were watching prices fall, someone else was watching something else entirely. Inventories, deficits, forecasts nobody revised, and a gap of over $20 per ounce that no headline explained. Somebody knew something, and by the end of this week, they made their move. The question is, did you? Welcome back to John AG. Now before we go any further, let me ask you for a small favor, just a small one. You know how when you visit your grandfather's house and he tells you a good story, you don't just say thank you and walk away. You sit with him, you listen till the end, you come back next week to hear more. That's all subscribing is. It's just sitting a little longer, coming back a little more often. It costs nothing, it takes 1 second, but it means everything to a channel like this one. So if this is your first time here, welcome. Pull up a chair. And if you've been here before, well, you already know what's coming. One more thing before we begin. Tell me, where are you watching this from? Which city? Which country? What time is it there right now? Type it in the comments. I read every single one. Now, let's begin. On the Multi-Commodity Exchange of India, silver did something this week that made a lot of people nervous. It fell. Not a small fall, a sharp one. 6.4% in just 7 days. For anyone holding silver, watching the number on their screen, it felt like the ground had moved. But numbers on a screen never tell the whole story. They only tell the part that is easy to see. Gold moved too, that same week. It dropped a little over 2% on the same exchange. Across the ocean, in New York, gold and silver both fell as well, and silver there fell even harder than it did in India. Two markets, thousands of miles apart, moving in the same direction, at the same time. That is not a coincidence. That is a signal. And signals, if read correctly, tell a person far more than the price itself ever could. Here is the strange part. The story most people were told this week was simple. Silver is falling because silver is weak. Demand must be dropping. Supply must be improving. Something must be wrong with the metal itself. But that story does not hold up under a closer look, because at the very same time silver was falling in price, the physical world around silver was not falling at all. Mines were not suddenly producing more of it. Solar panel makers were not suddenly needing less of it. Electric vehicle factories were not slowing down. Investors buying physical bars and coins were not walking away. If anything, many of them were doing the opposite, buying more, not less, while the price dropped. This is the first thing a serious observer must understand. There are two markets operating at once, and most people are only shown one of them. The first market is the paper market, the world of futures contracts, currency movements, interest rate expectations, and short-term trading decisions made in offices far away from any actual silver mine. This is the market that moved sharply this week. This is the market that produced the 6.4% number everyone is now repeating. The second market is the physical market, the actual metal, dug from the ground, refined, shaped into bars, wired into solar panels, soldered into electronics. This market moves slowly. It does not panic in a week. It responds to years of supply and years of demand, not to a single afternoon of trading. This week, the paper market spoke loudly. The physical market said almost nothing at all. And when those two markets disagree that sharply, someone is usually wrong. History has shown, again and again, that it is rarely the physical market that turns out to be mistaken. So the real question is not, why did silver fall? That question has already been answered by every financial news channel this week, in the simplest and least useful way possible. The real question is this: if the fundamentals underneath silver did not change, what did? And more importantly, who noticed the difference before everyone else did, and used it to their advantage while the rest of the market was still reacting to a headline? That is where this story goes next. To understand what really happened this week, one has to stop looking at silver and start looking at something most people never think to check: the US dollar index. It sounds boring. It sounds like something only bankers care about. But this single number, quietly climbing on a chart most people never open, was the true author of silver's 6.4% drop. Not mine output, not solar demand, not some sudden discovery of new silver reserves, a currency. Here is the mechanism. laid out plainly. Silver is priced in dollars, everywhere in the world, even on the MCX in India where it trades in rupees. When the dollar strengthens, silver priced in dollars becomes more expensive for buyers holding other currencies. Demand from those buyers softens. At the same time, a stronger dollar means investors can now earn a safer, guaranteed return by simply holding U.S. Treasury bonds. Silver pays no interest. It pays no dividend. So when the safe option starts paying more, some money quietly walks out of silver and into that safer option instead. This week, the dollar strengthened for a very specific reason. The Federal Reserve's chair delivered comments that the market read as hawkish, a signal that interest rates are not coming down anytime soon and may even rise further. Inflation data released that same week came in at more than double the Fed's target. Put those two things together, and traders did what traders do. They repriced their expectations, and the dollar rose. But there is a second piece to this puzzle, and it is one that almost nobody connected publicly. Crude oil fell nearly 10% in the very same week. On the surface, oil and silver seem unrelated. One is an energy commodity, the other a precious metal. But watch closely, because this is where it gets interesting. When oil prices drop sharply, it lowers the cost of transportation, manufacturing, and energy across the entire economy. That, in turn, lowers inflation expectations. And when inflation expectations fall, one of the main reasons investors hold silver, as a hedge against rising prices, quietly weakens. Two unrelated commodities, moving for reasons that seem disconnected, were actually reinforcing each other, pulling silver down from two directions at once. Now here comes the twist that most headlines conveniently left out. In the middle of this same week, tensions between two major world powers escalated sharply. Military strikes, retaliatory action, the kind of geopolitical event that, under normal conditions, sends nervous money rushing into gold and silver as safe havens. And yet, silver still fell. Think about that for a moment. A geopolitical shock hit the headlines, the exact kind of event that is supposed to push silver higher, and the metal dropped anyway. That single fact tells an experienced observer everything they need to know about who was actually in control of the price this week. It was not fear. It was not safety-seeking. It was pure financial positioning, dollar strength and interest rate expectations overriding a risk event that would have mattered enormously in almost any other year. This is the part serious money pays very close attention to, and casual observers almost never notice. When a safe haven asset fails to rally during a safe haven event, it does not mean the asset has lost its safe haven status. It means something more powerful is temporarily overpowering it. And temporarily is the key word. Because dollar strength driven by interest rate expectations is not permanent. It shifts the moment new economic data arrives. And there was new data arriving within days. So the 6.4% drop was never really about silver at all. It was about a currency, a central bank's tone, and a barrel of oil. Three forces stacking on top of each other in the same 7-day window, creating a price move that looked dramatic on the surface, while the actual metal underneath remained untouched. But if the price was being pushed down by forces that had nothing to do with silver itself, then somewhere, underneath all of this noise, the real numbers were still sitting there quietly, waiting to be noticed. And those numbers tell a very different story. While the price of silver was falling on trading screens, a very different set of numbers was quietly being published in industry reports that almost nobody outside the metals world ever reads. And these numbers tell a story that contradicts everything the falling price seemed to suggest. For 6 years in a row now, the world has consumed more silver than it has produced. Not once. Not as a temporary blip. 6 consecutive years. This year's shortfall is estimated at roughly 46 million ounces, and that gap is wider than it was the year before. Widening, not shrinking, even as the price dropped. Here is where it gets stranger. Since 2021, the world has been quietly draining silver out of its above-ground stockpiles to cover this shortfall. The cumulative drawdown sits somewhere between 700 and 760 million ounces, depending on which source is measuring it. Vaults that once held reserve silver have been steadily emptying, year after year, to keep up with demand that supply simply cannot match. Why can't supply catch up? This is the twist most people never think to ask about. Silver is not usually mined on its own. Most of it comes out of the ground as a byproduct, while mining companies are digging for copper, lead, zinc, or gold. The amount of silver produced is decided by the geology of those other metals, not by silver's own price. So even when silver prices climbed above $120 an ounce earlier this year, mining companies could not simply produce more. The silver comes out when the copper comes out, nothing more, nothing less. Supply is, in a very real sense, trapped. Meanwhile, demand keeps expanding from directions most casual observers never consider: solar panels, electric vehicles, advanced electronics, and now, increasingly, the data centers powering artificial intelligence. All of them depend on silver's unique properties as a conductor of electricity. Yes, some manufacturers are trying to use slightly less silver per unit as prices rise, but the overall industrial appetite keeps growing regardless. And here is a detail that should stop anyone scrolling past this. Physical investment demand, people and institutions buying actual silver bars and coins, not paper contracts, is forecast to rise by 20% this year. 20%. While the price was falling on the exchange, buyers of the physical metal were doing the opposite of panicking. They were accumulating. Now, layer in what the world's largest financial institutions are quietly saying, in reports rarely covered by mainstream headlines. One major global investment bank has a full-year price forecast for silver sitting more than $20 above where the metal is currently trading. Other major institutions place their forecasts in a similar range, well above the current price. And here is the twist that deserves real attention. None of these institutions revised their forecasts downward after this week's price drop. Not one. Their models, built on years of supply and demand data, did not change, even while the price on the screen did. Think carefully about what that means. The people with the deepest access to data, the most sophisticated modeling, and the largest capital at stake looked at the exact same 6.4% drop that alarmed everyday traders and did nothing. They did not panic. They did not revise their outlook. Some, in fact, appear to have used the drop as an opportunity rather than a warning. This is the quiet asymmetry that rarely gets explained to the public. A structural shortage, 6 years running. Stockpiles being drained. Physical buyers increasing their purchases by double digits. Institutional forecasts sitting well above the market price and refusing to move. And yet, the price fell 6.4% in a single week, driven not by any of these facts, but by a currency index and a central banker's tone of voice. Somewhere in that gap, between what the price says and what the physical world is actually doing, sits an opportunity that patient, well-informed capital has quietly been watching build for months. The only question left is what happens when the forces pushing the price down finally run out of strength, and the numbers underneath are the only thing left standing. Every gap eventually closes. That is one of the oldest truths in any market, and it applies to silver just as much as it applies to anything else. The gap between price and reality does not stay open forever. The only uncertainty is what forces it shut, and who is positioned correctly when it does. In the days just ahead, a handful of economic reports are scheduled for release, reports most people will scroll past without a second thought. Manufacturing and services activity data, inflation figures out of Europe, and the one that matters most of all, the monthly employment report out of the United States. Here is why that employment number carries so much weight. If hiring comes in strong, it tells the market the economy can handle higher interest rates without breaking. That supports a stronger dollar, and the pressure on silver continues. But if hiring disappoints, if the numbers come in weak, it tells a very different story. It suggests the economy is cooling, which reduces the case for higher rates, weakens the dollar, and removes the very force that pushed silver down this past week. One single report, released in a matter of minutes, capable of reversing the entire narrative that dominated the headlines just days earlier. This is the twist that separates a casual observer from a serious one. Most people were told a story this week about weakness in silver, but weakness was never really the subject. Timing was. And timing is precisely the thing that gets decided by data most people never bother to check. Now consider the technical picture sitting quietly underneath all of this. Momentum indicators on silver are showing levels historically associated with extreme selling pressure, the kind of reading that, in past cycles, has often preceded a sharp reversal rather than continued decline. That does not guarantee anything. Oversold conditions can persist longer than expected, but history has shown, again and again, that when a structural shortage collides with an oversold price and a shifting rate environment, the reversal, when it comes, tends to be fast, and it tends to catch the majority of participants unprepared. There is one more detail worth sitting with. The ratio between gold and silver prices, a simple measure of how many ounces of silver it takes to equal the value of 1 ounce of gold, is currently sitting at an elevated level. Historically, whenever this ratio has climbed this high, it has often marked the early stages of silver outperforming gold as the ratio corrects back downward. Not on a fixed schedule, not with certainty, but as a pattern that is repeated across multiple cycles, quietly, in the background, while headlines focused on something else entirely. Put all of this together, and a very different picture emerges from the one presented earlier in the week. A 6-year supply deficit that keeps widening, inventories that keep draining, physical buyers accumulating rather than retreating, institutional forecasts sitting well above current price and refusing to move, technical conditions historically associated with a turning point, and a single upcoming data release with the power to reverse the very force that caused this week's decline in the first place. For the business-minded observer, the entrepreneur thinking in years rather than days, the lesson here is not about silver specifically. It is about the discipline of separating noise from signal. The price on a screen reacts to a currency, a policy statement, a single data release. The underlying value of an asset reacts to something far slower and far more difficult to manufacture. Years of imbalance between what the world produces and what the world actually needs. Those who confuse the two are destined to make decisions at exactly the wrong moment, buying when the reversal has already happened and selling when the fundamentals were never broken to begin with. The numbers were never hidden. They were published, quietly, in reports that most people simply never opened. The only thing that changed this week was which numbers the world chose to look at. And that choice, more than any single price move, is usually what separates those who profit from uncertainty, from those who are simply consumed by it.